Income Tax Act and what are the steps in calculating income tax of a particular assessee. Okay, so to begin with, Income Tax Act, as I told in the previous video, was introduced in the year 1961. Okay, and it was made applicable from the 1st April to the 1962. That means there are a lot of income in the contemporary today's time that were not applicable in the year 1962. For example, there were no demat accounts back in 1962. There was no cryptocurrency income. So all those incomes were introduced very recently. So what is the taxation implication of that, and how does Income Tax Act cover the taxation of all those items? It does so by introducing the Finance Act every year, which is presented in the Parliament in the form of budget. So the budget that gets presented in the Parliament later gets converted into a finance bill, and then after signature of the President of the country, it gets converted into Finance Act. So all the recent amendments and the major changes that are happening in the economy that are done in Finance Act. So basically Income Tax Act 1961 plus the Finance Act that is introduced in that particular year, when you make a combination of these two, you will be able to understand what are the direct tax laws of that particular assessment and previous year. Not only that, sometimes there are confusions about the interpretation of the law. So for clarifying the interpretation, there are a lot of circulars, notifications, clarifications. Those are issued by CBDT. Now what is CBDT? CBDT stands for Central Board of Direct Tax. Okay, it is a governing authority which looks after the income tax regulation in the country. Very regularly they bring up circulars, notifications and clarifications for the clarity of the interpretation of the law. And not only that, the judiciary of the country, that is your High Court and Supreme Court, those entities are responsible for right interpretation and implementation of the law. Which is why all the recent and all the landmark judgments of the High Court and Supreme Court are also considered as benchmark whenever there is a confusion or a litigation. So when you study all of these legislations in combination, you will be able to better implement the income tax law that is applicable to you in that particular year. Having said this, let us try and understand what are the steps in calculating income of a particular person. Okay, step number 1 is determination of residential status. Okay, now residential status should not be confused with the citizenship of the country. Okay, residential status is determined based on the number of days a person has stayed in a country physically. So once you identify your residential status, whether a person is a resident or a non-resident or a non-ordinary resident, that determines a lot, or that makes a lot of difference in the taxability of a particular person. After residential status, we understand the classification of income in the various heads of income. Okay, there are total 5 heads of income which we will cover in detail. I will just mention the name to you. Income from salaries, income from house property, income from business and profession, income from capital gains, and income from other sources. These are the 5 sources of income where an assessee can earn the income on which he might be liable to pay taxes. So we will segregate the income earned by a person in these according to their heads of income. Okay, then we calculate or we make a total of all of these heads of income combined. After that, we apply clubbing provisions. Now clubbing provision means if a income of a son is to be clubbed or is to be considered as the income of the father, what are the provisions, right? If a person who is 12-year-old earns any income, will a 12-year-old pay tax on that money? Not necessarily. Okay, it might be included in the income of a father or a mother. Okay, so those are called clubbing provisions. After you do that, we will apply the set off and carry forward rules. Set off of the losses from losses of one ahead from the income of other head. So those are set off and carry forward rules, again which we will understand in detail. Then we apply deductions. Okay, then we calculate total income. Then we apply deductions which are available under chapter 6A of Income Tax Act 1961. Basically, income tax gives you a relief from your income if you make investment in certain instruments that government wants you to make investment in, or if you spend your money on a certain things which government considers necessary, like education of children. So if you make investments in certain schemes of the government, or if you spend money on the education of your children or healthcare facility of your parents or self, in that case income tax act gives you relief, and you can claim deduction of those payments from your income. After the deduction, you will get your net taxable income. Okay, and that net taxable income, in that net taxable income, when you apply the slab rates of the taxation, that is when you get the total tax that is payable by a person in that particular year. Taxes paid by a person can be of three types. Okay, first is the income tax. First is the tax that is paid at the regular rate. Second is the surcharge, which is an additional amount of tax which might become applicable if your total income exceeds a particular limit. So the regular tax plus the surcharge, if it is applicable to you, and after you add the total tax and surcharge, finally you calculate cess at the rate of 4% on the amount of the tax. Please note that the tax rate will be calculated on the income, but surcharge and cess will be calculated as a percentage of your tax liability. And after you add all three of them, the final amount is the tax payable. Okay? Now, when do you pay the tax? When do you pay the tax? There are two terms that you need to understand in this context. Okay? First is previous year and second is assessment year. Okay? First is previous year, second is assessment year. Previous year means the year in which you are calculating, the year of which you will be paying your income tax. Okay? And assessment is a year in which you calculate the tax income that you calculated or earned in the previous year. To give you a numerical example, okay, if you are calculating income of the year 23-24, that means the year that started from 1st of April and ended on 31st of March 2024, that is the previous year 23-24. The tax calculation of that year will happen in the year 24-25. So the year 24-25 will be called as the assessment year. So basically assessment year is the year in which tax of the previous year is calculated. Agreed everyone? Okay, so this is the meaning of previous year and assessment year, and what are the slab rates that we are going to apply, that depends on the assessment, that depends on the slab rate of that particular year, which we will cover in the upcoming video. Thank you so much for your time and attention. I'll see you in the next video.